futures trades, Mikey, this was one that we went at length about on our live stream this week. We looked at the trade entry checklist. Today, you had the idea of like, let's just do like a quick high speed version of this, because a lot of people interested in what futures have to offer, especially from the small exchange, efficient small products. To me, that's like the perfect thing for everyday traders, which is, oh, I don't have to put up 50 or 100% of this product, and it's not too big for me to trade. But where we lose a lot of people is, how do I execute this futures trade? What should I look for? What should I make sure of before I put my hard-earned cash into play? And I can appreciate that, and I understand where they're coming from. And I mean, I know that you, as a relative to me, more recent trader, this was probably something to get over as well. Like, you can paper trade, you can study for as long as possible, but you still have this like iffiness before you click that button. You have to make sure that you're on the right side of things, that you chose the right product and everything else. So you probably felt that before your first futures trade.
Totally. And I think it all comes down to mechanics, whether you're a professional athlete or you're a futures trader. You know, before you make that decision, there are going to be things that you have to check. And I think after you've been trading for a while, it kind of becomes second nature. If you're a TC trader, you're looking for things like high IV rank and a nice credit on some of those short option trades. If you're a futures trader, you're looking for an expectation of movement, maybe some directional assumption, the size and the relation to that position to your portfolio. So it just kind of becomes second nature. But at first, you got to build those strong fundamentals and set those mechanics. I think this is important for that.
Absolutely. And so I want to use yesterday's great example of opportunity, which was interest rates getting hammered. Like, they were down yesterday, the most that they've been down in a single day all year. And so say you see this, you read it in the Wall Street Journal, or you see it in your platform, or you see a tweet or what have you, and you're like, oh, sick, like opportunity. I'm going to go to the market. I've got an opinion on this. What do I have to do? Well, with interest rates, like things that aren't, when it comes to like, oh, Apple has one of their fancy annual meetings where they tell you the next evolution of the iPhone and everything else, you go straight to Apple stock and you pretty much know what to do there. With interest rates and some of these, in my mind, cooler, but a little bit more complex markets, Mikey, there is this question that comes up, like, do you have the right market? So like, if you see a story in interest rates, non-farm payrolls, the Fed chair people, someone comes out and says something, or you just read about, like yesterday, one of the biggest moves in interest rates in the last several months, are you going to the right market? Because a lot of people will go to S&Ps, for instance, or they'll go to maybe ZB futures or something like that, or they'll go to the euro or US dollar. Make sure you have the correct market. This is an underrated one here, where I think you get things started on the wrong page, you're going to have a bad experience.
Agreed. If you're looking for exposure in interest rates, and you're trying to construct some convoluted short XLF trade, or maybe you're looking at a euro because it's related to the dollar and interest rates and financing and the cost of money, you're not going to get the exposure you're looking for necessarily. And there's something to be said about being product indifferent. I mean, if TLT is the product for you, then go for it. Sure. But now you have something that is a pure play expression of the 30-year interest rate, and it's low cost and it's capitally efficient. If I want to trade rates, this is the product that I'm going to for sure.
I'm so glad that you brought that up, because yeah, we're talking about the small 30-year yield here. We also have the 2-year and the 10-year yield products as well from the small exchange, all initial margins under $300, really small standard products, get you going into interest rates. And it is that direct exposure, because too often people create for themselves this product where like interest rates are moving. Well, XLF is my interest rate product. And then it's like, oh, that's actually just a basket of banks like that tangentially are affected by interest rates. Like, why would I go to that? Like, why would I and you kind of like create it in your mind, this problem that you keep coming back to. It's like, well, XLF, that's my interest rate product. And you keep coming back to it and you're like, man, why isn't it moving though directly with the interest rates? Forget that, clear your mind, go directly to the market here that you want to trade. And if it's not yields and it is finance stocks, then yeah, go to XLF. But if you're trying to go to yields, go to the yield. From there, Do you have the correct product? I brought up ZB, a product that is margined at multi-thousands of dollars, moves on average anywhere from $500 to $1,500 per day. The correct product is essential to a good trading experience. Mikey, you know this, because the last thing you want is you got your idea, you got your market, which is interest rates. You go to buy or sell, and within 30 seconds, you're uncomfortable.
Yeah, you're not even really playing what you went there to play. And I think ZB is a great expression of interest rates. It's an excellent bond product for many people, for large portfolio managers, for institutions, for a lot of banks. But if you're a small trader like myself, and I was so frustrated with the lack of an interest rate product for many years, finally there's something that kind of accomplishes what I'm looking for. You're not looking to get $1,000 in movement in just 5 minutes or so. I mean, you want to be in a product that is comfortable for your size. And the cool thing with rates too, Frank, is the longer duration you go, the more volatility you're going to see.
Yeah.
So if you want to trade rates, you can trade the 30-year, which is moving more than the 10-year, which is moving more than the 2-year. So with these three products, you can really fine tune that risk exposure while maintaining the pure interest rate exposure at the same time.
Absolutely. And the nice thing about futures being efficient is you can look at that, margin. And if that number there, the buying power, the margin, whatever you want to call it, if that number is like in the thousands and you're not comfortable with it, then you shouldn't be trading that futures product, because that's an efficient measure of risk in that trade. The S30Y around $300 margin, S10Y $200, the S2Y less than $100. So there, like Mikey said, you can kind of pick your product there. You can pick your size, and all of those levels that I think most people would be comfortable with. But yeah, if you go to ZB futures and you're like, wow, this thing is $4,000. I hope it doesn't move 4,000. There's a good chance that it'll move 4,000 in the next couple of days. So keep that in mind, because that is probably the most essential piece there. From there, now we're getting more practical with it. Okay, we got the market, we got the product, Mikey. Direction is a huge thing, especially at interest rates. This may seem stupid, but are you buying the thing that you want here, or should you be selling it? This is a market that has long been confusing, because if you're trading ZB or ZN or TLT, if you buy those products, you actually want yields to go lower. You're bullish the bond prices, you're bearish interest rates. What's nice about yield is if you see something in a tweet or a news item or wherever, your bullish yields, you buy this product. Your bearish yields, you sell it. It seems, like, oh yeah, any idiot would know that. I've made this mistake before, and I was a professional interest rate trader.
Yeah, totally. It's kind of funny to think back about how we used to have to invert our assumptions. And the same thing was true with some of these currency crosses, right? I mean, if you were buying euros, you were selling dollars. And why did we have to invert everything? Finally, the world you live in is the world that you trade. You think rates are going higher, you buy one of these interest rate products, you think rates are going lower, you sell one of those interest rate products, and you even have a pretty exact reference of what the rate is. So you don't have to do some crazy financial calculation to derive how the price is related to the yield. Super simple here.
Yeah, what was really nice is like yesterday, the big move in rates. Maybe you want to catch the bounce. You see like, oh, outlier move in interest rates. I see it on Twitter and everywhere else. I want to go there and buy it. You saw the 30-year bounce from $22 to $22.50. That's just, you bought 2.2% and it bounced back to 2.25%. It's really intuitive there, and it moves along with those yields that you're reading about. Now from here, okay, market, product, direction. Now, where do I want to enter? If I am trying to catch the bounce here, I'm trying to buy yields, I'm bullish yields for whatever time frame. Do I want to wait? Do I want to pay up? Do I want to wait a long time? For me, it's always an in-between here, where like if the market in this example is at 22, I'm probably putting it in an order at 22.8 or 21.80, 21.90, something that's realistic, but letting the market come to me there, unless If it is, an opportunity where it's like, wow, this is a huge outlier, I need to get in right now, then yeah, I'll lift the offer there and just pay up into the market. The thing that can be problematic is if you're not realistic with that entry and you're saying market's at 22 and it moves about 50 cents per day, I'm going to buy it when it's down at 15. It's like, you're never going to get that trade on. It's not going to happen. I mean, what say you on where you enter here?
Yeah, I think this is one of the beautiful nuances of experience trading too, is understanding what the market is offering, what it's giving you on the bid, what's giving you on the offer, and where's the liquidity. I mean, if you have an order resting here at 18, it better be a GTC order because you're probably not going to get filled for a few days. So I think understanding the spreads and the liquidity, I agree with you. You should be placing limit orders right around where that midpoint is and work them if you have to. Not saying you should chase a market, but you should be kind of working around that price. And with the platforms that are available today, you can so easily do that. Yeah. Be an active trader and move your offer or move your bid to get the fill that you're looking for.
Yeah, absolutely. Like this is the opposite. And here, let's do a quick crypto corner with Mikey, the crypto genius. Dogecoin is at 40 cents. Where is it at?
Oh my gosh. Yeah. I think it went up from 14 yesterday to like 45 was the high today, 45. A few hours ago.
So that's a market that has gone from 5 cents to 45. So if I wanted to say to myself, hey, I want to get long Dogecoin, but I'm going to put in a bid at 5 cents, that's actually kind of realistic, right? Because like the market is moving 40 cents. Like it just literally expanded by 1,000%. So I feel comfortable putting in a bid that's 90% below where it is right now. Interest rates different. That interest rates is, I mean, maybe I'm wrong here, not Dogecoin at the moment right here. So when you have a market that in the last 6 months of trading has gone from $15 to $24, which is still a big move. I mean, not big relative to Dogecoin, but big move. You can't say to yourself, well, I'm going to buy it down at $5 because it's never going to get there. So realistic is different for every different kind of market. But just make sure you're going to be realistic in there, or else sometimes you'll never trade. And also, you don't want to be too aggressive. If you do have patience, you don't need to get filled in the next couple of seconds. Then yeah, work the bid a little bit below. Last piece. Sorry, go ahead.
The nice thing there too, Frank, that I just want to add as well is that all these smalls are ticking in a 1 cent increment that equates to $1. So it's not like you're working a Dogecoin order and it's so fractional and small, you don't even really know how much the ticks are. I mean, here, if you're moving up by 1 cent, you understand that you're moving up by $1. So much easier to compute where your entry and exits are and then base your profits off of that.
Underrated piece there because like if I was to go trade Dogecoin, it would be similar to what I did in NBA Top Shot, which Mikey just totally fleeced me. I'm pretty sure he was short NBA Top Shot and he told me to go in there and buy some.
Not true at all.
Because I went in there and I was just like, I don't know what this is and I don't know how it ticks. So I'm just going to lift offers and buy this thing wherever. Same with like Dogecoin where it's like, I don't know what this thing is. And I don't know how it ticks. Like it looks like the yen almost.
Yeah, exactly.
With the tick. Yeah. Like what do I even do here? Nice part of the small exchange futures. They all penny tick increments. They're all $1. Don't get caught up in NBA Top Shot. It's all BS. And Mikey, you owe me $100. But anyways, manageable exits is the last piece here, Mikey. You've got your market, you got your product, direction, entry point. Before you get hit on that entry, you want to think about, am I looking to make or lose $20, $50, $500? Because that's going to dictate a lot. If you're looking to make or lose $20 and the market moves like a NASDAQ or an S&P, you're not going to be in the trade a microsecond before you get hit on that. That's not realistic. That's not a manageable exit. Thankfully, small exchange products, all small enough that you can make or lose pretty much any increment that's not like $5 or $10. And even with the S2Y, that is actually a pretty fine exit point there. But this is something you want to think about before the trade, right, Mikey?
Totally. And you hit it right on the head, Frankie. You're talking about exit. That's profits and losses. Great resource for this is the subscriber newsletter, where we have projections for how much each of these markets move on both a daily and more medium to longer term basis. So before you even put that trade on, understand the liquidity and understand how much the thing can move in a single day. Otherwise, you're either going to be waiting way too long or you're just you're just going to hold it and it's going to move against you or with you. And you're going to have no idea what your expectations are. So set some expectations using that newsletter, or just reach out to us. Let us know your questions.
Absolutely, man. And great time to plug that newsletter. That's part of the Small Exchange subscription. If you haven't checked it out already, go to subscribers.thesmallexchange.com. If you've been on the fence, it's Friday. Maybe you got paid today. Pull the trigger, man. 50% off exchange transaction fees on all small futures for life as part of the subscription. You also, every Monday, we set you up with a bunch of data and places where you can form realistic expectations around your long and short trades. We've got pairs trade information, correlations, everything you need there goes out to our subscribers every Monday, along with the reduction on fees for life every time you trade the smalls, and giving away a bunch of merch to our subscribers every single month. We're in the process of re-upping on more hats. Mikey and I did a photo shoot this week. We're going to give away some shorts maybe to our subscribers in the next couple of weeks here. And we are giving away t-shirts pretty much every week now to subscribers and everybody else. So go check this out, subscribers.thesmallexchange.com. That is it, Mikey. How to enter a futures trade. Great little segment by you here on Friday afternoon. I hope everybody enjoyed it.